There are three deadly traps in the world of options trading that can cause you to lose money and potentially blow up your trading account. In this video, we dissect these three deadly traps in detail and show you exactly how to avoid them. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn so you can grow your trading account.
Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of my main jobs is to warn our traders to avoid mistakes that most beginner options traders make at one time or another. And the reason that this is so important is that some of these mistakes can literally destroy your options trading career before it really gets started, which is tragic, considering that some really talented traders never get to prove how much money they could have made because they blew up their account before they learned how to be consistently profitable. And so the purpose of this video is to teach you the 3 biggest mistakes that options traders make when they first start trading options so that you can avoid them yourself and give yourself a real legitimate shot at becoming a consistently profitable trader and getting yourself into a position where you can trade for a living. If you're absolutely brand new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand why the mistakes we share with you in this video can be so devastating. Then when you're finished, you can come back and watch the rest of this video. Okay, so the first mistake that options traders often make is that they confuse high win rates on a trading strategy with actual long-term profits using that same strategy. Now, this is going to require a little bit of explanation. So the trading strategies within the discipline known as options income trading, which is a dominant trading style on our proprietary trading desk. The reason that these strategies are so popular is that they have very high win rates, and you'll see in a minute why they do. But suffice it to say that it is the high win rates on these strategies that can ironically cause one of the most serious mistakes that you can make as an options trader, and that is to get lured into high win rate trades without doing any analysis as to the risks that you're taking. So let me give you an example. Let's head back to August 17th of this year. And as you can see, the S&P 500 index, also known as the SPX index, had been in the midst of a sell-off and closed at 4370.36 that day, down from its late July highs, which had climbed above 4600 intraday in late July before selling off. Okay, so let's say that on the next morning, August 18th, the SPX index opened up at 4346.90, and suppose that we had pulled up an options chain for SPX index options expiring that day. And he looked at a column on his broker platform called Delta, which is a column that every option broker will show for each option on an options chain. And an options delta is basically a prediction about how much the options price is going to change, but it also happens to have a very high correlation to the probability that the index will close above or below that particular option strike price. So for example, on this options chain for options expiring that same day, August 18th, the 4385 call has a delta of 11.27, which means that statistically there's about an 11% chance that the index will close above the strike price of that option, 4385. And similarly, the 4305 put option has a delta of 9.86, which means that statistically there's about a 10% chance that the index will close below 4305. And if you look at that column of deltas, you'll see that the 4385 call and the 4305 put are the closest calls and puts respectively to 10 deltas. And so suppose on that day we went ahead and sold 10 of those 4385 calls, which are the 11.27 delta calls, which is as close as we could get to 10 deltas. And those calls happen to be about 40 points above the opening SPX price. And simultaneously, we sold 10 puts at the 4305 put strike price, which were the 9.86 delta puts, which are also about 40 points below the opening price for options expiring that day. And then for protection, we moved up 25 further points to the 44.10 calls, and down 25 points to the 42.80 puts. And we went ahead and bought 10 of each of those for protection. So this structure, this sequence of short calls above and short puts below, straddling the index's price, flanked by long call and put positions farther away from the market, this entire structure is what is known as an iron condor to options traders. So let's first take a look at the cash flow implications of this trade so you can understand how this opening trade will affect the cash in your trading account. So starting with the short 43.85 calls that we sold for $1.68, you'll remember that each index option pays off $100 per point beyond the strike price of the option. So you multiply that price by 100, and we sold 10 of them, which results in total cash inflow from selling the calls of $1,680. And we also simultaneously sold the 43.05 puts for $1.55 for a cash inflow of $1,550, as you can see from the calculation. And then simultaneously, we bought 10 of the 44.10 calls for $330, while at the same time buying the 42.80 puts for $480. So when you net everything down, you end up with a positive cash flow of $2,420, which gets deposited by your broker immediately into your account. Now, the amount your broker will require for this trade is $22,580. So that's the amount of capital you'd be putting to work to enter this trade in this size, which you need to know if you ever decide to enter a strategy like this. Of course, if you have less capital in your account, you just reduce the size of the trade to fit your account size. Okay, so let's move now to the end of the day because the options expire at the end of the day, and so we can finally value them. And as you can see, the index ended up on that day closing at 43.69.71, which in this case is lower than where the calls were and higher than where the puts were. So in other words, the index closed between all four options. And so what does this mean for the results of our trade? Well, that's pretty easy to discern because as you can see from this table, because the calls expired above the index's closing price and the puts expired below the index's closing price, the result is that all four options expired worthless because index calls only have value if the index closes above their strike prices, and index puts only have value if the index closes below their strike prices. And so since none of that happened, they all go out worthless, meaning that the original cash flow that we received from selling that iron condor, that 24.20, was in fact our full profit for the trade. And so that trade turned out well. And is that a big surprise? Well, it shouldn't be, because if you think about it, there really was an 80% chance of that being the outcome of the trade in the first place. Now, why do I say that? Well, think about it. If the short calls are located at 10 deltas and the long ones are farther away from the market, then the market is more likely to rally to the short calls than the long calls, because it would have taken a much bigger move for the market to reach the long calls. So if the chance of the market closing above the short calls is 10%, and obviously an even lesser chance for the market to rally all the way up to the long calls, then obviously the chance of both calls expiring worthless is 10%. And the same is true on the put side. The market's only 10% likely to close below the short puts and a much smaller chance to close below the long puts. So the chances of both puts expiring worthless is also 10%. And so if you add up the chances of either of those things happening, it becomes a 20% probability, which means that there's an 80% probability that neither of those things will happen, meaning that there's an 80% chance that all of the options expire worthless, which means that we just keep the initial cash flow 80% of the time statistically. So that's pretty cool, right? An 80% chance of winning this trade every time and pocketing that initial cash flow, which this time was 24.20 in this case. Okay, so let's say we did this every day of that week. And if you have options backtesting software, you can actually simulate this, and you're going to find that starting with the trade we just won, the 24.20, the next 3 days would also have been quite profitable trades. And we would have won 4 days in a row for a total of $7,360. after our 4-day winning streak, for which something with an 80% probability of profit, again, shouldn't be super surprising. Makes sense, right? So let's now move to the 5th day, August 24th. And so that morning, with the index opening at 44.4561, we put on the 10 Delta Iron Condor again for the 5th time. The short calls at 44.80, the long calls at 45.05, the short puts down at 44.05, and the long puts at 43.80, which in turn produces cash, just like we explained before, of $19.90 in this case, and your broker would have required you to have $23,010 in your account to make this trade. But in this case, the index had a very large sell-off that day, closing down almost 60 points at 43.7631. And so let's see how our trade turned out. And so taking this option by option, we'll start with the call side, which is going to be easy because both the 45.05 and the 44.80 call positions expire worthless. But when we get to the puts, it's a different story because the puts pay off $100 per point that the index closes below that put's strike price, which, as you can see from the calculation, closes at 28.69 points below that, which means that we who sold those puts are going to have to pay out $28,690 on those puts. And we get a little bit of help from the 10 long puts we bought at 43.80 because those are 3.69 points below the index's closing price, and we bought those. So those pay us $3,690, which gives us a minor offset. And then, of course, we get another offset from the original cash flow because that was paid to us upfront, so we keep that. But in any event, the entire trade ends up being a big loser in the amount of $23,010, which when combined with the previous 4 wins, still results in a large loss of $15,650. And so win rates can't be confused with profitability. It's not enough to have an 80% win rate. If your losses are so large compared to your winners that they wipe out the results of your winners, even with a super high win rate, the system makes no sense. And so what's the solution to not making this tragic mistake of confusing win rates with profitability? Well, it's easy. For every strategy that you're considering trading, make sure that your tests show that the number of wins per year times the average win, which you can call your win dollars, minus the number of losses per year times the average loss, which you can call your loss dollars. When you do that calculation, the remaining number has to be not only positive, but positive enough that the profit you're making executing this trade consistently provides a solid return for the capital you need to trade that strategy and the effort you're putting into trading that strategy. Which leads me to the second huge mistake that beginner options traders make, and that is that amateur traders frequently make the terrible mistake of assuming that a lucky beginner winning streak is sustainable. And so they substantially increase their capital right after that winning streak occurs. So let's go back to the example we just covered to drive home this point. In the 80% return scenario that we just went through, you'll remember that the first 4 trades were wins, which resulted in a total profit of $7,360. But this time, let's assume that the 5th trade, the loss, instead of being that horrible $23,010 loss, instead was a much more reasonable $5,000, which makes the 5-day total a healthy, positive number of $2,360, even including that loss. And therefore, there's much more balance between the size of the wins and the size of the losses. And so after the first 5 trades, you can be encouraged that there's a possibility that this trading strategy could make sense long-term if we continue to trade it, and the same win rate and risk-reward relationships remain about the same. But suppose you said to yourself after 4 trades, hey, this is an awesome trade. I never lose money. This trade is basically an ATM machine that automatically spits out thousands of dollars every day. I'm crazy only trading a 10 lot. I should start trading a 40 lot and make 4 times the money. Think about how much more I would have made had I decided this 4 trading days ago. I would have been up over $29,000 today. And of course, the day he decides this is the day of the $5,000 loss, but now he has a $20,000 loss on his hands driving his reasonable, nice gain by the end of the week into a very large loss by the end of the week because he became overly enthusiastic and unrealistic about the strategy. And so what conclusions can we draw from this example? Well, first of all, you've got to be suspicious of any winning streak, especially at the very beginning of your adoption of a trading strategy. No strategy doesn't lose sometimes. You've got to know that. Instead, you should not increase your capital level on a strategy until you've experienced a loss on that strategy or a series of losses, and ask yourself, am I comfortable losing this amount of money in a single trade? Because if you're not comfortable losing a trade at the current level, how are you going to even consider increasing your capital and exposing yourself to an even larger loss? The right way to scale up is to first experience a loss or a series of losses, then ask yourself, was I truly comfortable with that level of loss? If the answer is yes, then and only then can you slowly and gradually scale up your capital. If you shock yourself psychologically with a big loss after you've scaled up, you honestly may never recover from that experience, and you may actually ruin yourself as a trader. Okay, so now our third and final deadly mistake that novice options traders make all the time, and it can be quite a costly one, is when a trader sells a covered call on a stock that they've become super bullish on. So let's take a look at an example, and then this mistake is going to become really glaring to you. So let's take a look at Tesla stock, which, as you can see, pretty much sold off for the entire year in 2022 from as high as 400 earlier in the year, down 75%, all the way down to nearly 100 by the end of the year. But as soon as the new year started in 2023, the stock began to bounce. And by the end of January, had rallied so that by the end of the month, Tesla had reached 173.22. And let's say that a trader, for whatever technical or fundamental reason, had formed a belief that Tesla was going to rebound in 2023 and at least rally back up to that 300 level from which it sold off in the last half of 2022. And so as a result, the trader buys 200 shares on January 31st at its closing price of 173.22. Then his buddy says, hey, have you ever heard of covered calls? Well, they're a way that you can basically get a dividend on a stock like Tesla, which doesn't pay a dividend. And he explains to you that a covered call starts out with your owning 100 shares of a stock and then selling a call option on those same shares that you own on a call that expires at some point in the future. And so a covered call position like that can have two possible outcomes. If the stock closes at any price below the strike price on the day that the call option expires, the trader just pockets that call premium to receive that he receives initially. But if the stock closes above the strike price of the call option he sold, then his shares get sold for the strike price of the call he sold. And again, he pockets the premium that he originally collected for selling that call. And so you become intrigued and you completely forget about your prediction that the stock is going to bounce to 300. So you pull up an options chain for 5 months later in June of 2023. And you notice that the Tesla 195 calls expiring in June, about 22 points higher than where the stock's trading now, is trading for a price of $18.15. And so you sell 2 of those calls against your 200 shares of Tesla. And the reason that you did this was that you got really excited about the fact that if you sell those 2 calls, as you can see from the calculation, your brokerage account will quickly be credited with $3,630. Recognizing that the 200 shares cost you $34,644, you realize that this means you just got paid a kind of dividend, so to speak, on your Tesla shares because you receive $3,630 for the calls and your investment is $34,644, and so the resultant return is 10.47%, a kind of dividend on a non-dividend paying stock, mind you, in less than 5 months. And when you consider that the average S&P 500 stock pays less than 2% a year, that's incredible, right? Well, let's just see how incredible that really is. So let's move to June 16th, the day that these covered calls expired. And as you can see, Tesla had indeed bounced, as the trader expected, rallying to 260.54, which is an 87-point rally from when he entered the covered call trade in late January. And so because the call's expired, we can now calculate the result of the covered call trade. And so first of all, you need to realize that because you sold those two 195 calls, you're required to sell your shares at $195 per share to the call buyer, the one you sold the call to. In fact, your broker will execute that transaction automatically, which means that you no longer own those 200 shares of Tesla. And so to calculate the outcome of a covered calls trade where your shares get called away, you have to add the profit you made on the shares to the cash you received for selling the covered calls in the first place. And so you calculate your share profit, obviously, by subtracting from your mandatory sell price of $195 the original cost of the shares, which was $173.22, which results in a profit of $22.78 per share times 200 shares, which gives you that $4,556 in profit from the shares themselves. You then add to that the cash you got for the covered calls in the first place, and you end up with a gain of $8,186. But let's now compare that to the profit you would have made had you just held the shares and took advantage of the full run-up in Tesla shares. And so looking at the current 260.54 price of Tesla and subtracting the 173.22 original cost of those shares, you see your profit would have been $87.32 per share, which means that your profit for the 200 shares would have been $17,464, $9,000 more than you would have made with that covered call transaction that you were so enamored with. By being cute and selling a covered call on a stock that you were super bullish on, and you were in fact right, you ended up costing yourself a great deal of money, basically because you fell in love with the idea of paying yourself a handsome dividend on a non-dividend paying stock without realizing that you were creating an obstacle for yourself given your very bullish thesis on the Tesla shares. And so what we must learn from this is that the covered call is a neutral to mildly bullish strategy. But if you're super bullish, it's wise to simply stay away from covered calls because there's nothing more frustrating than being right on a trade, but cutting your profits short by getting cute and selling a covered call too low on the options chain, far below your estimate for the price of the shares in the future. Rather, you need to ask yourself, what is my realistic price target for the shares? Whatever that number is, you should place your covered call at a strike price no lower than your price target. That way, if the shares reach your target price and the calls force your shares to be sold because they're located at the strike price, you're happy for that to happen. After all, you're selling your shares at target. What's not to be happy about? And so what I'd like you to take away from today's video is that options trading can be a terrific way to make a living, but you need to understand that every trading practice has pitfalls, some of which are minor and can be ironed out over time, and others which can literally crush you, which are the issues we've discussed in this video. If you want to grow and prosper as an options trader, you simply can't make fatal errors like the ones we discussed in this video. If you want to live to trade another day and actually become a mature, successful trader, please follow the advice we shared with you in this video and give yourself a really good shot at being able to trade options for a living.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.